Welcome to Comply on the Fly with M3 and Karen B, your trusted resource for quick, reliable insights into employee benefits compliance. Each episode delivers clear answers to common compliance questions. Whether you're tuning in for the first time or you're a seasoned listener, we're here every other week to make navigating compliance a little easier. Please note this podcast and the contents herein do not constitute legal advice. In all cases, employers should consult with their own legal counsel. Let's dive in.
Hello everyone, I'm Karen B, and the Comply on the Fly topic for today is the One Big Beautiful Bill Act, or as our industry is a lover of acronyms, OBBBA. This sweeping legislation was signed into law by President Trump on July 4th, 2025. There are many provisions in this bill, but we will focus on the changes to employee benefit plans. These are the notable provisions that impact employee benefits. First dollar telehealth coverage and HSAs. As you may remember, during COVID, HSA-compatible health plan participants were allowed to contribute to their HSAs despite having first dollar telehealth coverage, meaning that telehealth benefits could be provided prior to the deductible being met, and participants could still contribute to their HSAs. However, the government failed to extend this exception at the end of 2024. The OBBBA has now codified this exception and applied it retroactively to 2025. Employers that sponsor HSA-compatible high-deductible health plans, or HDHPs, can allow for first dollar telehealth services, and employees will still be able to contribute to their HSAs. Second, direct primary care arrangements and HSAs. Beginning January 1st, 2026, coverage provided by direct primary care or DPC arrangements will not be considered other impermissible coverage for HSA contribution purposes. This means that an individual can be covered by a DPC arrangement and still make and receive HSA contributions, even if the DPC benefits are provided prior to the satisfaction of the deductible. The bill requires that in order to qualify, the direct primary care arrangement cannot charge more than $150 a month for individual coverage or $300 a month for family coverage. Also, the DPC arrangement cannot provide general anesthesia services, prescription drugs, or laboratory services not typically administered in an ambulatory primary care setting. These requirements are not entirely clear, and the bill directs the regulators to provide additional clarification and guidance. In addition, HSA dollars may be used to pay for DPC fees. Third, bronze or catastrophic marketplace coverage and HSAs. Beginning January 1st, 2026, all bronze and catastrophic level plans available in the federal marketplace will be considered qualifying high-deductible health plans for purposes of HSA health savings account compatibility. And finally, the dependent care FSA limit will be increased for tax years after December 31st, 2025. And this increases from $5,000, which it has been for a very long time, to $7,500 annually. Plan documents should be updated if employers who have dependent care FSAs wish to allow employees to contribute up to this new maximum. Although the OBBBA did not include many employee benefit provisions that were in the original bill, the surviving provisions do provide some relief to plan sponsors that particularly offer HSA-compatible plans. And that is your Comply on the Fly topic for today. Thanks for tuning in.
For more employee benefits compliance insights from Karen B and her team, please visit m3ins.com.